how do we reconcile that? How do we reconcile that his camera and his whole production is multiples better than ours? That's what needs to be reconciled. Jesus. Mike, congratulations. You're welcome anytime. You're welcome on any time. Neil, I think that's for you.
I don't even know what the question was. Wow. Hold open. Here we go.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, September 19th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeRaff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Jeff, where are you?
I'm in the Midwest. I'm in the middle of Michigan, and it is roasting hot here, but I'm in I guess it's a ballroom. But I'm headed to South Bend to watch the Boilermakers play the Irish. I don't know that this is going to turn out well for the Boilermakers, but little football. I kind of was hoping for a sweatshirt and jeans. This looks more like a tank top and flip flops, but we'll see.
Hey, make sure you wear some sunscreen for that skin of yours, will you?
Thank you. Indeed.
It's a public service announcement. All right,
I think I'm going to go with the big bucket hats. Those are in now, right? I think that'd look good on me. 100%.
All right, big week this past week. Neil, Fed meeting, what are your thoughts?
Well, they did the expected, which is cut 25. I think Powell caged it as a risk management move. In my opinion, I think he sort of did that really to get a consensus so everyone could kind of hold their nose and vote for the cut. When you look at the distribution of the dots, at least for the rest of the year, the median shifted up to 3. So that means 2 more cuts for this year. So there's a meeting in October, a meeting in December. And the median is looking for a cut in each of those 2 meetings. I wouldn't say that a cut in December is a lock. The markets appear to be trading it that way, but it's probably, frankly, closer to a 50-50 proposition than most realize. I mean, it's a very divided Fed. I mean, you had, I think, 10 folks pencil in 3, and you had 9 pencil in 2 or fewer, basically. So, there was even someone looking for a hike. So I don't.
Was that Lisa Cook? It had to be Lisa Cook.
No, I think it's the Kansas City Fed president.
Okay.
Who's quite hawkish. But hey, I mean, this is one of these things where there's what President Trump wants, and then there's how he goes about trying to sometimes get what he wants. And could Lisa Cook have been persuaded for a 50? Maybe. But since you're trying to push her out the Fed, I don't know, maybe she only signed up for a 25. I thought what was interesting, frankly, is that in July, both Governors Waller and Mickey Bauman, and remember, his name is in the ring there for the, to succeed Powell. Both of these folks dissented in favor of a 25 basis point rate cut in July. Okay, so that was before the last jobs number, which was terrible, right? So they would have been totally within their remit and intellectually consistent to vote in favor of a 50 basis point move. Right? That would have made total sense. They didn't. Okay. So I think that's kind of revealing about maybe some of the internal dynamics on the Fed. I mean, it was an interesting meeting. But for now, I think, the markets are kind of looking at it 25, most likely another 25. The Fed, I think, has another cut baked in for next year, but there's so much of a distribution gap, like it's a very wide dispersion of estimates and things, that it's really hard to have much conviction around anything after the end of the year. So But the internal dynamics are quite interesting. We did have one dissent, which was Governor Myron on loan from the White House. But this is one of these things where, if you're going in there kind of, on a kamikaze mission, what would you do if a kamikaze pilot's coming at you? You move out of the way and you move maybe closer to the people that you know, right? And that's kind of what happened, right? So perhaps you could have had more of a forceful defense of 50 had someone not gone in there guns blazing advocating for it. So I do think that the internal dynamics of it are actually quite interesting and potentially, maybe revealing. But, I thought it was interesting, again, that Powell said that 50 wasn't under serious consideration. Compared to last July, where the Fed didn't actually cut, but they said it was a close call when they didn't. So
remind me never to be in a foxhole with you, because when you cozy up to me, I know
I'm about to hit the fan. Exactly.
Well, it's just one of these things where, look, I think, like I said, Waller and Bauman would have been intellectually consistent to go along and dissent for 50. They didn't. It's also one of these things where, could it have been a situation where if they all dissented for 50, it would have looked too political, and then would you not have gotten a cut at all? These are some interesting scenarios to kind of think about. So it's always important to remember, like, the personalities around the table and, how best to influence them in trying to get the policy outcome that you want.
So speaking of that and the sort of palace intrigue and getting people to do what you want, I want to address a little bit of the FCC issue and Jimmy Kimmel, only because I think, Steve, as you pointed out this week, it has some implications going forward, right?
That when you're not funny, it's easy to get canceled. It's one thing. I know you're not talking to me, but it's one thing. It's one thing to lose your fastball. It's a totally different thing to never have had a fastball.
Wow,
that's for you, Jimmy.
And that's the.
What are you talking? Were you not a fan of the Man Show back in the day?
Actually, I wasn't. I thought it was a little too. I don't know. I wasn't a big fan. I did like, though. What was the one with Ben Stein? He did that too, where Ben Stein was kind of the straight man. It was a good straight man, wasn't he? Part of that whole
Ben Stein's Money or something.
Yeah. Wasn't he? I think he was the guy on that. That was actually good. The Man
I'm
Show.
shocked to hear that you didn't. I could totally see, like, Jeff with, like, one of those, like, helmets with, like, the beer and just watching the Man Show.
That's just not who I am. That's just not who I am.
That's just not who I am. You've evolved since I first met you, I guess.
I'll take another
It's
Chablis,
not who
please.
I am anymore. The qualifier. It's not who I am anymore.
No. That's all right. The good news is actually the best news is that there was not Instagram. There was none of that stuff in my 30s or 20s or teens. Yeah.
Yes. They're barely phones back
then.
then.
I would just say, right, like, right-wing cancel culture is when you stop making money on your show, then you get canceled.
Right, exactly. Right. Exactly. All right. Yeah. Well, so Steve, you're up after that diatribe.
I will try to transition and not refer to Jimmy Kimmel's Karl Malone impersonations. But
when you say transition, what do you mean?
The regulatory. That's not going to touch that one either. But with respect to the regulatory environment, if you are a media company right now looking to operate this space, just look at the sequence of events. Kimmel made the comments, I believe, on Monday. You had the FCC chair, Brendan Carr, come out critical of them shortly after. And then you saw two broadcasters that actually broadcast ABC's affiliate networks. I believe it was Sinclair and Nexstar. Say, we're going to go ahead and preempt the show and pull it. And Nexstar has a big merger case before the FCC. They want to acquire Tegna, another large distributor. I believe Disney has cases before the FCC. I believe they're trying to get this merger approved between ESPN and the NFL network. So, there's probably some business interest here. I know that was definitely the allegation when Viacom, CBS's parent, made the decision to pull Stephen Colbert. And I just think the takeaway from, again, the government position is sort of, we have to, if you're a media company, look at what the political implications are going to be on the regulatory environment and try to do what you think is the best thing for your shareholders.
Look, I think it's important to realize that, yes, free speech is the, it's the bedrock of who we are. But that is not to say that free speech comes without consequences, right? And in the public arena, you can say whatever you want. But as an employee, as someone who's within the capitalist system, you have to be mindful, right? You don't even have to agree, but you have to be mindful of what you say and how you say it. And that's just exactly what happened here. And I don't blame them. I'd be more interested. It's unfortunate, in my view, that there is this, this potential merger, because I'd like to see what would happen without that potential of conflict, right? Like, if that was not the case, because Sinclair and Nexstar, they're far more, their audience, their locations are far more red state than blue state, right? So it'd just be interesting to see if that was, really the impetus for the cancel, or was it because of this business interest with the merger?
In other words, you'd prefer a situation where Kimmel got let go the same way Colbert got let go.
Well, even that one was a little more contentious, right? But yeah, 100%. I'd just like to see it.
You're not making money, buy.
Correct. 100%.
Yeah. I mean, the whole thing is just kind of interesting. I do think it's all of these things are so much more simplistic than people let on. I mean, at the end of the day, one side is upset that what they did to the other side is now being done to them.
Yeah.
Yes.
That's all this is. It's just human nature.
We won't pull on that thread because that's another 45 minutes and I don't have that much time. Right. But you're right. I totally agree with you.
As Mike Tomlin said, no more poop in that butt.
Damn. All right.
All right, let's move to housing. Jeff, Neil, I'll start with you, Neil, because I think we can loop it into the rates call and whatnot. Where are you on housing?
Housing's getting worse, not better. That's all there is to say about it.
But worse, as you pointed out, it's, in your opinion, it's worse than most people are giving it credit for.
Well, yeah. I mean, I think, so first, you remember, when you talk about housing, you're really talking about three different pieces, at least for economics, right? It's construction, sales, and renovations, okay? So starting with construction, housing starts are running below housing completions. So what that basically means is that housing units under construction will continue to come down, okay? So there's less pipeline for construction activity. When you look at sort of traditional leading indicators for housing construction, I mean, Jeff talks about up and to the right. These are all going down and to the right, right? Builder permits, units authorized, that's been declining now for the last 5 months, and frankly, at a fairly meaningful pace. So I'd expect that to continue, but at any rate, I mean, the fact that building permits are declining probably means that construction-related employment will continue to come down, right? So if there are fewer homes being permitted, there's probably less need for builders to be constructing homes, which also means there's less need for them to have lots of employees. I thought the Lennar earnings this week were sort of interesting. I mean, they talked about how they're going to give the market a chance to catch up. That's usually code for we're kind of done letting our margins keep going down. And if you don't want your margins to come down anymore, well, what are you going to do? You're going to take actions to defend your margins. In this case, that probably means they're going to sell fewer homes and make fewer homes, which means you need less people to do all these things. So there's going to be a volume loss there. I think construction employment will continue to head south over the course of the year. And now it's just a question of what other things does that take down with it? The housing market's not good. And, on sales, I mean, it's one of these things where it's trying to time the momentum in the markets, right? I mean, obviously, duration has been a fairly good trade this year. I mean, you've seen longer term interest rates generally come down, and then the Fed cut. And, we've gone from like 610 to 630 on 30-year mortgage rates inside of a couple of days since the Fed cut. So in other words, maybe a lot of, we squeezed a lot of juice out of the long end, and it's probably maybe we're in like sort of a period of transition where we have to kind of see rates go up a little bit before maybe they come back down. And at any rate, mortgage rates are higher, so that probably puts sales back in the penalty box for a couple of weeks, right? And Redfin had an interesting analysis looking at the gap between sellers and buyers. And look, there are more sellers than there are buyers. If there are more sellers than there are buyers, what do you think that means? It means home prices will keep coming down, and that's a price signal. And they're coming down in the places where builders make homes. It's the South and the West. And so, I think construction is going to look pretty sloppy going forward. And,
what's interesting from our perspective is the home builders have had a pretty good rally, right? Starting in kind of July, they broke out and caught up with the rest of the market, from the tariff talk, and they got overbought. Our home builder ETF showed excessive inflows. I think all of that in anticipation of the Fed cutting rates. Obviously, now that is on the tape, and they've started to come in and consolidate. Honestly, they're mixed. It's a tough call from just the charts. They've had a good rally. Some of that's been enough to improve the trends, but not definitively turn them. Sometimes you just have to put things on the pile of too tough to call, and I would put home builders there. What's interesting around that, and to Neil's point, is that the building product names actually look weak and continue to weaken. So they have not had that same rally, which you would expect, obviously, in the sequencing that would work as well. So I think home builders have responded to the anticipation of rate cuts. The building product names have not, and they've continued to weaken. So we'll see how that plays itself out. But certainly the tops in a lot of these building product names look more ominous than the improvement that we've seen in home builders.
Yeah, I want to give a big shout out to Hadley Peterson Landscape Design, because she's a big fan of the show. The folks over there they listen to our stuff because they want the insight on what's going on in the housing market. So there's another example of somebody outside this business who relies on us for our good information. So nice job there.
Well, geez, Steve, if you're doing that, can you ask him how to make my rhododendrons look better? Because they just, I don't know what's going on there.
It's Hadley's a woman, so she'll you know what? We're going to get a response from that. Hadley, if you're listening, a response to Jeff on why the whatever.
Well, if you said landscaping, I presume that they do rhododendrons and other things.
They do all the design. So we're going to get an answer for you. Thank you for being a listener to the show. Jeff, I do want to sort of take off on that in terms of the yield curve. I know you had a piece out this week to our clients about sort of yield curve normalization, sort of what the yield impact model suggesting about equities going forward. So you want to sort of dive into that a little bit and give us some thoughts?
Yeah, sure. Well, I think the big thing was, and Neil can attest to this, right? How many wrong recession calls were there based on the yield curve, Neil? Right? I mean, people were 100% in the recession call.
It's not the inverted curve. It's usually the cuts, the aggressive cuts. That's the recession signal. It's the steepening, not the inversion.
So, right. So what we were looking at, right, was let's look at what kind of influence did quantitative easing and, let's call it financial repression have that actually happened in Japan, right? It happened in Europe. It happened in the U.S. So it was global. But we focused on the U.S. because we have the data far and deep and wide in that. And, it was pretty clear. So we chopped it up into three parts. We said, okay, pre-GFC. So through 2008. We then looked at post-GFC through 2022, and then from 23 on to where we are today. So obviously, that's a shorter time frame where we are today. But what we did, and you have to do this with everything, and we do this with everything, is you have to measure the efficacy through time, right? How good are these things? You do that through T-stats, and I'm not going to get too technical on this stuff, but you can do it through math. And, there's a very clear relationship pre-GFC, Great Financial Crisis, that the short rates were statistically significant to forward returns for the S&P, obviously negatively. So the lower the short rates, the better the performance of the S&P. And then the steeper the curve had a statistically positive relationship with forward returns for the S&P. So the steeper the curve got, obviously because short rates are coming down, the better the S&P's performance. When you take the 15 years, post GFC, so 2009 through 2022, those T-stats, none of them were significant. They all ended up being, really marginal. In fact, not even close to being significant. So there was really a loss in the efficacy of using rates or the curve or any combination thereof in making an S&P call because of that financial repression, right? In other words, the government was putting so much money in the system that the market just wasn't getting its signaling from the bond market. And you can see that in Japan, and obviously with this kind of normalization in Japan, you've had a great equity rally as things kind of come back into pricing. And that's not even happening in earnest the way it's happening here. But the point being that as we got through 2022 and over the last 2+ years, that significance has started to match where we were pre-GFC. In other words, we went through a 15-year period where it just didn't matter, and now it's mattering again. So for bulls out there, what you want are lower short rates and a steeper curve. Those things are statistically meaningful. They're good for equities. That's where we are today. So I think that's good news. But I think probably more importantly is that the pricing mechanism and the signaling mechanism of yields and the curve is going back to the way it used to be. In other words, we can glean some information about the health of the economy. We can glean some information about what that's going to mean for equities by watching these again. And again, the good news is that they're moving in the right direction for bulls.
Right, they're moving in the right direction, and then you've got small caps making new highs. You've got micro caps making new highs. So it feels like that is that risk on trade.
Yeah, and so we did it. We'll have that out on Tuesday. We're doing it again for other asset classes, so not just equities, but other asset classes, other factors, other sectors, right? So you can see, because I'll tell you right now, you had a flip flop in banks. Banks used to respond in one way, and they respond another way to the curve after the GFC, right? So that looks like it's coming back to the way it used to play, and that should be good news from our perspective, particularly because the last thing you want is an indicator that tells you something and is robust. And then it just lies to you, right? And it goes negative the other way, because what are you supposed to do with that? Do you believe it's a new regime, or do you believe that at any moment now we're going to go back to the way it used to be? Like you just don't know. So it becomes useless. So we measure that, all of our indicators, we measure those through time. And it's true that, things have a hot hand. There's some that will be very, very good at a particular point in time. But even when they're not good, you still want them to be influential. The last thing you want is that sign to flip, right? I had a positive relationship and now I've switched to a negative relationship. That is the kiss of death.
Right. And that's just another example of the sort of in-depth stuff that we do at RenMac that goes beyond just this pod. So if you're interested in that sort of stuff and you're not getting our work, please reach out to renmacaccess.com and subscribe to us. And if you're an institutional client, then we'd love to have you to be a client going forward, or institutional account. We'd love for you to be a client going forward.
Or if you want skincare recommendations, you can give those too, right?
I can.
Yeah, we do everything here.
We do everything. Clearly I didn't do enough because I look very red on the camera. I don't know what's going on here.
The sunscreen, man. You're of that age.
that is Rhoatia. So we got the mailbag coming up. New process for the mailbag. We had asked previously if people wanted to submit some videos or some audio commentary. So I think we have one this week. So Harry, we're going to turn it over to you to show us the new format of the question.
Yes, it's very happy to see a very good video come in this week. And yes, we have the video from Mike Singleton, and let's play it.
Hey there, RenMac. Policy question here. In the September Summary of Economic Projections, the FOMC revised its expectations for both growth and inflation higher, and yet its expectations for the policy rate were revised lower. How does one reconcile this data and the conventional wisdom around monetary policymaking? Thanks.
Oh,
wow.
How do we reconcile that? How do we reconcile that his camera and his whole production is multiples better than ours? That's what needs to be reconciled. Jesus. Mike, congratulations. You're welcome anytime. You're welcome on any time.
Wow. That was
Neil, I think that's for you.
I don't even know what the question was.
Yeah, Mike, I've been asking myself that question about, trying to, I think part of it is I'm always reminded of Yellen when she looked at the projections and talked about the dots and just kind of, remember these are sort of individual projections. You don't want to always, you don't want to spend too much time trying to make sense of something that you can't make sense of. And, you also have to think about the incentive structure around some of this, right? So, like, for example, in 2026, the median unemployment rate estimate ticked down 1/10 from 4.5 to 4.4. So the Fed sees the unemployment rate declining in each of the next 3 years, in 26, 27, and 28. And but think about it this way: does anyone honestly believe that they would ever pencil in an unemployment rate going up materially over the next 3 years or next year? So they think the unemployment rate is declining next year while saying there are downside risks to the labor markets right now. So you would never do that. I mean, there's probably a little bit of a limit to how worried they can show they are in these projections. You know what I mean? Similarly, with respect to inflation, there's never going to be a time ever where the projections won't show inflation going back to 2%. Ever. That'll never happen, because that's an admission that you're not doing your job. In the same way, penciling in much higher unemployment would be an admission you're not doing your job. So I think the best thing to do in this situation, Mike, is just to sort of take the 2026 outlook as with a grain of salt, because there's clearly like a wide range of opinion on where rates are going to go next year. I mean, that distribution looks very wide. I mean, you have a fairly there's not much conviction, in other words, around which way things are going to go. So I think the best thing to do is kind of just focus on the here and now, and kind of remember, what Bernanke once taught us, which is, typically the primary conduit for communicating with the public and the markets is the post-meeting press statement. And that clearly talked a lot about risk to the job market. And that's was the reason why they pushed in the direction of cuts. Okay, so I wouldn't try to spend too much time trying to rationalize the 2026 numbers. I don't think there's really much conviction among Fed officials around anything beyond the next meeting or two.
Mike, thanks for that question and sending in the video. That was great.
And wonderful production.
Yeah,
and
unbelievable.
Well, I do find it hysterical how Jeff is like talking about how their production's better than ours, when I don't know who's the person running the investment behind the RenMac podcast infrastructure. There you go.
Wow.
So you want to know why, Jeff?
It's because I give too long a leash to certain dogs. I give too long a leash to certain dogs. It's nothing more than that. We'll leave it at that.
Mike, it sounds like you're going to be hosting this show next week. I'm out.
I will say though, and Harry, I love you, but it's definitely a much cleaner production listening to someone give their video than Harry read the questions off Twitter.
Oh, I like no. You're such a
damn.
No. Oh, I'm talking to you. Look at Neil. All right. We'll get you a hat, Mike. Nice RenMac hat. Maybe the next time you show up on a video, you'll wear that for us. Looking out this week, Steve, what do you got going on? Post-mortem on the Xi Trump phone call, sitting around the water cooler?
Yeah, I keep getting the best transitions. Yeah.
Hey, Steve, let me ask you a question for real. Does she speak English? Because I'm pretty sure Trump doesn't speak Chinese. But is there like this interpreter thing? It has to be, right?
No, I mean, they have. And one of the reasons that the calls always take longer, particularly with China, is you do have interpreters on both sides. I don't know if Xi speaks English. My guess is he probably speaks a few words. I think it's clear that when Trump and Putin are riding around in the limousine, that Putin speaks English. But that's sort of a foreign leader thing where they like to speak their native language.
I will say
some would say Trump speaks Russian, but
my personal favorite is like, have you seen? He's done like these joint press conferences with like Modi, for example, the Indian Prime Minister, and obviously you have both American press and Indian press, and so you have an Indian reporter asking Trump a question in English, and Trump's like, "Say that again." He's like, I don't know what he's saying. It's just the accent. I can't. I love it. It's just so good. It's like, so not only does he need an interpreter for foreign languages, he needs an interpreter for foreigners that speak And it's just the way he says it is just so hysterical. It's like the accent. I can't do it. I just can't.
It's on brand and authentic. I think that's.
I don't know. I don't even think it's a debatable point. Like, he's clearly the funniest president we've ever had.
Well, on that note, I'll look at, I think that this call is going on as we're recording this podcast. So I'm waiting to see whether or not we're going to announce whether Trump is going to China next month or whether they're going to try to meet on the sidelines of the APEC summit in Korea. If Trump's going to go to China, that's a big domestic win for Xi. And then sort of what did Trump demand for that? Is that going to be an increase in purchases of soybeans, increase purchase of Boeing aircraft? Those are two things. Again, you think about what we export, that seems to be right potentially. So that's sort of how I would watch that. Recording this now, so we'll see whether or not there's any news on NVIDIA. I don't think it's a coincidence that you saw NVIDIA take a large stake in Intel. That is a good move for Wong. I just speak from the political side because that sort of might bolster the chances that the Trump administration will allow him to export this Blackwell chip to China. So I think he's playing the long game there. And obviously, China's sort of come out with this antitrust, I guess, concern with respect to NVIDIA chips, sort of directing domestic companies there to buy more domestic chips. So again, I don't believe in coincidence. That's something to watch. One thing to watch next week on the international front, we've talked a lot about this UN General Assembly gathering in New York. So that's going to have a lot of world leaders there together. That makes opportunities to talk more on trade. So we could see some headlines there. U.S. negotiators met with their Indian counterparts this past week. The India side suggests a lot of progress was made, but they talked about, a framework within months rather than weeks. So maybe we won't have a big announcement next week with respect to that. And then domestically, I think this showdown is probably going to extend to next week. And we're recording this before the votes today. The expectation is that the House is going to pass a GOP-led stopgap, and then the Senate is going to take up both the GOP-led proposal as well as a Democrat proposal, and they're probably both going to fail. Remember that you need 60 votes in the Senate. Republicans have 53, so that's sort of the rub. And really sort of watching to see if House Republicans are able to move their proposal. That really determines Schumer's negotiating leverage there for Democrats in the Senate. Obviously, if Republicans failed, he would have more negotiating leverage. So I think he's just sort of waiting to see that. A lot of time between now and September 30th. Is it possible the Senate comes back earlier next week, maybe Thursday or Friday, after some of the Jewish holidays potentially? But at this point, I'm seeing signs of progress. If Republicans are able to pass their version in the House, to me that sort of reduces the risk of a government shutdown. And if you're listening to this and they haven't, then that obviously increases the odds of a shutdown. So I think that's really going to be a thing to watch next week and probably beginning of the week following.
Great. Neil, what are your thoughts? Next week?
We do have a decent run of data next week. So the S&P Global PMIs are going to be released. Those are September data points. We'll also get data on August new home sales, so kind of keeping that housing theme going. And then we'll get the core inflation numbers for August. And again, I mean, core PCE is probably going to come in a little bit lighter than has been the case. Remember, there's different ways to kind of look at the same concept. So in economics, you have CPI and PCE, and those are trying to get at the same concept, but there's differences of how those numbers are constructed. But it looks like core PCE is going to be running below core CPI in the latest month. And then, we'll also get data on income and spending for August. Jerome Powell is also talking on the economic outlook next week on the 23rd. He's going to be talking in Rhode Island, so we're curious to see what he has to say. And then, again, newly minted Governor Myron is going to be speaking before the Economic Club of New York on Monday. We look forward to being in attendance for that. So
that's great.
That's it.
Jeff?
Well, look, I think a couple things. One, the cyclical versus defensive trade continues to work, continues to have legs. Momentum started to pick up, so that's good. So that which is up continues to go up. Beta has continued to work, and that is going counter to our call, which we thought beta would soften. It has not. We are seeing semiconductors now overbought, and that's not just an Intel effect. That is, more broadly. I think that's one of the hot areas that probably needs to consolidate. But generally, I like the impact that we're seeing from cyclicals versus defensives. More specifically, you want to see discretionary continue to improve at the expense of staples. That's been happening. I think the small cap rally and new high throws an awful lot of cold water on the breadth bears that are out there, because it's a sign of breadth. When you're making a new high in the small cap index, it's a sign of breadth, right? 2,000 names going up generally. I think the market's in a pretty good spot, and a little overbought in some spots, but I think momentum will continue to be the better factor than beta, even though the beta call has not worked out for us in the last 6 weeks or so. I still continue to believe that momentum, if you look historically, has a kind of elongation of trend. It tends to trend where beta tends to fluctuate and oscillate through time, and it's now overbought. So if you have beta that has momentum, I'm okay with it. If you have beta that doesn't have momentum, I think you're going to have a problem. But generally, I think the market's still in pretty good shape. We'll obviously watch rates. We'll watch the dollar. I think rates will probably bounce. The 10-year yield, you've got resistance at 420. You've got a lot of support down at 380. So we'll see where we are. But generally speaking, the trend is down at the 10-year yield. It hasn't broken down yet for the 30, but it's been in a continual downtrend, I think, now for maybe 18 months on the 2-year. So trending back to that study that we were talking about, what we're seeing in rates should portend good news for the equity markets as we go.
That's great. We'll end it there. Great stuff as well. Mike Singleton will send you a hat. Hadley Peterson, make sure you reach out to Jeff on his landscape design needs. For everybody else,
I think it's acidity. I think I need more acidity in my soil. We'll see. We'll see what she says.
There we go. For everybody else, go to renmac.com for more information on how you can be a client. We love to have you on board. Follow us on X. Follow us on all the social media platforms, YouTube, etc. We'll be back next week with a special guest, so make sure you join us then. But until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
And
I'm Neil Dutta.
And I'm Steve Pavlik.
There we go. Have a great week, everybody.